Welcome back, family. It is Kyle King here, your course instructor for Classroom to Boardroom, and we have made it to course 10, where we will learn seven strategies to helping you securing a suitcase. Now, I say suitcase because one, we're not just trying to secure the bag. You can't take bags. If you think about going on a plane, because all of these courses are gonna help you get on vacations and travel around the world and share this knowledge around the world. So what I'm saying is that you can't take a huge bag of knowledge, a huge bag of money on the plane. It's gonna have to get checked in. So we're training you, and today we're gonna learn 7 steps, 7 strategies to securing a suitcase. But before we get started, I want to thank you, and I'm so proud of you for making it this far. You've gotten to lesson 10, and we have one more left after this, and then we'll be able to go into the next module. But I want to really talk to you today about securing the bag, securing the suitcase, and let's talk about money. So the first step is start investing now. Now, I was talking to a friend the other day as we were creating this, and I was explaining to him the power of compounding. And what compounding means your money doubles over a period of time or triples over a period of time, however you want to look at it. And we talked about the power of compounding and how much positive effect can have on your investment portfolio and on your life. And I asked him, I was like, hey, if I gave you $1 million right now, or if I gave you 1 cent and it compounded doubly every single day for 30 days, what would you choose? He said, of course, I would want the million. And then I said, are you sure you want the million? And he said, yes. That's a stupid question. Like, it's just a penny. So what I showed him is how I could take one penny, and create in 30 days $5 million. Actually more than $5 million. And it's out there. You can Google it. Pretty much just type in on Google compounding in 30 days, what that looks like if it's compounding doubly for 30 days. And what it shows you is that when 1 penny turns into 2 pennies, 2 pennies turn into 4, 4 to 8, 8 to 16, 16 to 32, all of these different things, it continues to doubles. And then pennies turn into dollars, dollars turn into hundreds, hundreds turn into thousands, thousands then turn into millions, and then it's just continuous after that as you continue to compound doubly. So I want to say this, I'm not a registered financial advisor or anything of that nature, but these are 7 strategies that have worked really well for my life, and start investing now is so important. I was reading an article the other day about a billionaire. He's a hedge fund manager. He's actually the founder of Citadel, and what I saw is that he just invested $268 million in buying a penthouse in New York City. Now, one, in my opinion, that's just way too expensive. But then I found out that I believe a few months before that he purchased like a few floors in a Chicago building, and then a year ago he purchased a $218 million property in London, and all these different things. And what I started to read about who this person is, he is a billionaire hedge fund manager that started to invest in his college dorm room at the age of 19 years old. 19 years old, he started to invest, he started to trade, he started to learn the market and all these different things, and that's why it's provided him with the knowledge and with the capital to be able to invest in all these different properties. And that last property that he purchased was the most expensive real estate property that was sold in New York City. So it was absolutely crazy. So the second step, and we're gonna erase this because I may need the whole board for this, is create a plan that is the 3 S's. So that is simple, specific, and special. It's not about what matters to your mom. It's not about what matters to your boss. It's not about what matters to your professor. It's about what matters to you. So you want to create a plan that is special and unique to your goals, your vision. You want to create a plan that is simple. Like, yo, I want to do this here, And then you want to create a plan that's specific to how you're going to be able to accomplish the overall goal. And the strategy that I use to accomplish all goals is the SMART goals. And I'm sure you've heard of this all the time. So things that are specific, that are measurable, like how am I going to actually measure it? Attainable. Is this actually realistic here? And instead of time bound, because sometimes they put time bound here, I'm going to put tangible because these are investments that we're talking about. When can I have it in my hand? When can I see the return on my investment, right? So I want you to really look at this as your guide to creating financial goals. So this is your financial goal strategy. I want you to make smart financial goals. Don't just make goals. Don't just make goals that matter to you that are simple, specific, and special. I want you to make smart goals that are simple, specific, special financially, and then create the strategy around it to be able to execute on those strategies as well. So the next thing I believe is so important, it's so important, is a concept that I learned years ago. And number 3 is you get rich. A way that you can get rich is by buying stocks and stay rich by buying or investing in bonds. So a way that you can get rich is by buying stocks, but a way that you can stay rich is by truly investing in or buying bonds. And I learned a concept that really worked for me and has really played a great advantage in other people that I've kind of mentored and given them the advice as well. I want you to first assess your job, assess your career, assess your profession. If you're an entrepreneur, if you're a government worker, whatever that is, if you're a corporate CEO, whatever that is that you do. And I want you to ask yourself, is my profession, is my life a stock or a bond? When I'm thinking of stocks, you have to think a little bit more volatile. And what I mean by volatile, it's a little bit risky. All volatility means is continuous shifts and changes in the market. And when I'm thinking about bond, it's a little bit more secure. So if you're a government worker, you're going to have something that's a little bit more secure. You're going to have something that continuously pays you a certain salary. Your job is secure. You're not going to just get fired. But if you're an entrepreneur, that's more so of a stock lifestyle. It's more volatile. You have to work harder for your checks and all these different things. Sometimes it's not always going to be the same. It may be up, it may be down. The time may fluctuate, how much you're getting paid, all these different things. So ask yourself first, am I a stock or am I a bond? If I'm a stock, you need to invest in bonds. If I have a volatile lifestyle, I don't need to be investing in things that are also volatile, because if I lose money, that's my lifestyle, right? But if I am a little secured lifestyle, and I know I'm bringing in the same salary monthly, then I do have the opportunity of investing in a little bit more riskier investment as well. But I want you to, besides this, I want you to understand, I want you to stock where you shop. If you are the person that always shops at the same places, that always goes to the same restaurants, eats at the same restaurants, or goes to the same movie theater, all these different things, think about track. Like don't think about track, but I want you to think about the things that you do. And then I want you to track all of the places that you go to, all of the money that you may spend. We talked about in the last lesson in terms of budgeting. And then I want you to check their stock prices. I want you to check how these companies are performing. Are they public or private corporations? Do they have stocks? What are the price of their stocks? Because if you already have a predetermined relationship with these companies, then that's how you'll learn how to really determine the quality versus the quantity. Because that's actually the next step. Is step 4 is quality versus quantity. I believe that quality companies, in my opinion, are the companies that dominate industries. The Nikes, the Googles, the Facebooks, the Amazons, the Netflix. Quality companies, in my opinion, are usually the ones that their stock prices, their earnings really follow, their stock price follows earnings. And in terms of what I wrote down is that you want to stay away from what you don't know. In this investment game, in the securing the suitcase game is what we call it, stay away from what you don't know. Stay away from the things that you really don't know a lot about. Get comfortable, build that muscle memory of the things that you do know, the things that you're maybe interested in or knowledgeable in. And then, like I said earlier, stock where you shop. The quality companies are the companies that have been there for a long time, the industry leaders, like I said. But what you can start to see is that don't just focus on the big boys. When you start looking at stock price, I want you to go in, and you can go to Yahoo Finance or different places, and you can go in and look at the 5Y on the graph, and that's going to show you where their stock price was 5 years ago, and if it's either went up or went down. You're going to see the different spikes in the market, the price shifts, the different things that maybe accounted for that shift. You could Google what was going on during the shift. I know in August in 2015, Nike, the athletic corporation, had a major spike in their stock price. It like skyrocketed. Now I didn't know what went on in that time, and so many different things can affect stock price. The markets, the economy, politicians, all kinds of different things, products, all kinds of different things can affect stock price. And what I want you to start getting into the process of when you're stocking where you shop is looking at what led to the different factors that shifted stock price, so you can become educated on learning the economy and knowing when the trends or when the next trend is going to happen. The next thing is consistency is key. Consistency definitely is key. I recommend people investing every single month. And I know we talked about it last lesson about having that investment capital account as well as that savings account. But I recommend people investing every single month, because you got to think about it. Money spent equals it's spent and you don't have it. And that equals negative returns. The money spent, you're not getting it back. The money that you could have potentially invested. Remember last time when we talked about that $5 and how if you spend $5 every day, it will equal 1,020. And then if you did $15 a day, it would be like $5,000 and some change. What if you would have taken that $15 daily and invested that daily? What if that $5,000 would have had a 1% or a 10% interest, and you would have gotten those dividends back, or the annual returns? You want to not look at the cost of products that you're going to buy, to the cost of products that you're going to buy. You want to really look at the cost of, if I'm buying these products, what is that truly going to cost me in the future? The cost of what it's going to cost you outweighs the cost of the initial product, good, or service that you're buying. You have to look at everything as an investment, not as an expense. Invest your money, invest your time, invest your energy, not just spend, because then that doesn't give you a return on your overall investment. The 6th point is buy and hold. Now, when I was explaining this a little bit earlier today to one of my students, they were like, Mr. King, what does it mean to buy and hold? Now, regardless if you're looking at it in real estate, whether you're looking at it in the stock market, whether you're looking at it just in really anything, this strategy is so critical if you understand just global economics, American economics, just business in general. It's not about the timing of the market. It's not about this. This is not what it's about. You're not waiting on this to happen. All you're waiting for is it's not the timing. It's the time in the market. It's the time when things consistently, over time, over time, maybe have a little dip, but over time, they get you to the place of increasing in the worth, increasing in the stock price, increasing in the value, and increasing in the profits that you're going to be able to get as the investor and as the person that is going to be on the other side. So really all buy and hold means is patience. Let me write this down. Patience is the key to profit. If you want more profit, you're going to have to learn more patience. If you want bigger returns, you're going to have to learn more patience. If you want more, just in life, more finances, you're going to have to learn patience. Remember what I said. It is not about the timing of the market. It is about the time in the market. And one of the biggest points that I like to make to people, the biggest risk of investments is not being in the market and the market goes down. The biggest risk is being out of the market when the market goes up. I think that a lot of times in my experience with even myself is that people, when the market shifts, when the market goes down, when people get a little antsy, people get a little antsy. Actually, when people get a little antsy, some people get a lot of antsy because they're taking their money out, they're pulling their investments, they're liquidating their assets, all these different things, and then the market then spikes, and then all their money's out and they haven't made a return on their investment. They didn't get a chance to make the true return on what they were going to make. They got so caught up in the news and politics and economics and the global economy and things that were going to happen that didn't happen and things that didn't happen that were going to happen, all of these different things, and they pulled out their money, the stock goes up, the markets go up, everything goes back up, and then it's just like, I'm not gaining anything. So in the last step, the last strategy, and I know you guys are gonna be, this is so controversial, but I want you to learn to love Uncle Sam. My man, Uncle Sam. Yup, I'm talking about taxes. I'm talking about the government. I'm talking about all of the things that people hate to talk about, because you have to get to the point where if you understand how to leverage your finances, if you understand how to leverage your taxes, then that is truly how you develop wealth, true wealth strategies. So tax deferment, all that means, as we know, there's student loan deferment, there's all kinds of deferment. All that means that you don't have to pay all of it up front. And it said in my research, you get investments or you really get tax breaks if you hold, and this is going back to the buy and hold strategy, if you hold your investments for 12 months or more. And as I'm reading, what I want you to understand is that you have to learn the true value of tax deferment, the true power of tax deferment. What I want you to get to the point of understanding is that these percentages are going to get lower and lower and lower as you hold. The more you hold, the least likely you'll fold. The more you hold, the least likely you'll fold. And what I mean about fold is fold to taxes, fold to all of this profit that's being taken from you. Because one little tip here is if you invest in opportunity zones, and real estate is an opportunity zone, is just pretty much a place in rural districts usually. And if you can, a strategy that you can use is invest in these opportunity zones, and in 10 years it's tax-free off of the capital gains. Tax-free off of the capital gains. So say you invested in $2 million and you brought in $5 million in terms of capital gains over a 10-year period. All of that $5 million is tax-free. So what I want you to get to the point is not just getting your money up front and doing the different things that you need to do right now and then liquidating your assets, or if the market not if the market crashes, but if the market gets a little tough and a little rough, you're pulling your money out and you're pulling your hard-earned money out. What I need you to do is buy and hold. What I need you to do is invest now. What I need you to do is stock where you shop. What I need you to do is understand the market so that you can start building monuments of investments for not just you, but for your family legacy, for your family name. Invest that money, the dividends, the gains that you get, use that money to send your children to college. Use that money to go to college. Use that money to buy that property. This is the purpose and the power of the investments, and these were the 7 strategies to really help you secure the suitcase, and I look forward to seeing you guys in the next lesson.